You understand the strategies. Now let's watch one actually play out. This is the short strangle. We're going to walk through a real scenario from entry to management so you can see exactly how it moves and what to do when it gets uncomfortable. Because it will get uncomfortable, and that discomfort is almost always just noise once you understand what you're actually looking at. Here's the setup. Implied volatility has spiked recently. Nothing extreme, but noticeably above where it's been sitting. Premiums are elevated and we can collect better prices than we could a few weeks ago. We sell a call and a put simultaneously on the same stock, both at 25 delta, one on each side of the market. The call sits above the current price, the put sits below it. We're not picking a direction, we're selling premium on both sides and letting time and decay do the work. We go out 45 days to expiry deliberately. At 45 days, our 25 delta strikes sit at a comfortable distance from where the market is trading, giving us room. And we still get that sharp decay rate kicking in as we move through the back half of the contract life. Closer expiries would put our strikes too near the current price for comfort. 45 days gives us the best of both worlds. Because the market has been trending upward, we decide to protect ourselves on that side. We buy a call at 10 delta above our short call. That caps our risk if the market keeps running. Our upside is now defined. The downside short put we leave open intentionally. Our plan is to manage it by rolling, which we'll get to in a moment. We're in the trade. Days pass. Theta is working. Premium is bleeding off both contracts. Then around the 7-day mark, the stock drops. Our out-of-the-money put has now moved in the money, and when you look at your screen, it looks awful, a large red number staring back at you. Here's what that number actually is. Almost entirely intrinsic value. The put is in the money, meaning the market has moved past your strike and the contract now carries real dollar value reflecting exactly how far in the money it sits. It looks like a crisis. It is not a crisis. When you strip that intrinsic value away and look at what extrinsic premium remains, it's nearly gone. Theta has done its job over those 38 days. So you buy that contract back. You pay the loss, which is essentially that intrinsic value. At the same time, you sell the exact same strike put in the next expiration out. That new contract carries all of that same intrinsic value in its price, plus a fresh load of extrinsic premium on top, because it has a new full cycle of time value to sell. You have swapped one contract for the next. Same strike, new extrinsic premium coming in, a new 45-day clock starting. Your position is alive again. This is called rolling out, and you can do this as many times as you choose. Every time you roll, you collect new premium. Every new cycle, theta starts working for you again. The one scenario where rolling becomes a real problem is a market that keeps trending hard against your short side without pausing. A put going deeper in the money with each roll starts to cost more to buy back than the new premium coming in. That edge compresses and can flip negative, which is exactly why we defined our upside with that 10 delta long call. We protected against the side that concerned us and left the other open to manage by rolling. That is the short strangle in practice: entry, management, and the roll. Once you've seen it play out once, the mechanics become second nature. Take it for a test drive on the Passive Nomad Simulator. It's the best tool for replaying market history. Choose your expirations and watch how decay and volatility impact your position in real time. Free to use, cutting edge, and includes 0 days to expiry simulations. This is where theory meets reality.